Here's a number worth pausing on. The yield gap between the Bank of England and the Federal Reserve is now close to zero, and yet the pound is still standing. As of Wednesday, the 5th of August 2026, pound sterling to US dollar is trading around 1.3450, with buyers clinging on above the 100-hour simple moving average. That is simply the average price over the last 100 hours of trading, a short-term line in the sand that tells you whether the immediate trend still points up. Right now, it does. Price is sitting in the upper half of the recovery that started at the June low of 1.3150. That is roughly 300 points clawed back, and sterling is refusing to hand it over. So what has changed? Two things. First, the Bank of England's base rate sits at 3.75%, and with the yield gap against the dollar almost gone, the pound has lost the interest rate advantage that normally pulls foreign money in. Second, the technical picture has shifted from a clean uptrend into something much more finely balanced. Forecasts published on the 31st of July flagged sterling weakening below 1.3450 even while the longer-term uptrend stayed intact above the 100-day moving average, with momentum still leaning bullish. Other desks are blunter, treating the 1.3360 to 1.3400 band as the true pivot and fading rallies until it is cleared decisively. Both views can be right at once, because this is a range, not a trend. Why does this matter if you never place a trade? Because 1.3450 helps set the price of your summer holiday, your imported electronics, and the sterling value of overseas company profits. A firmer pound makes American travel and dollar-priced goods cheaper for British buyers, but it squeezes exporters and trims the earnings of FTSE companies that bank in dollars. This morning the mood was broadly risk-on, oil was catching a bid, and the euro was holding above 1.1650. Meanwhile, the New Zealand dollar came under real pressure after unemployment hit a 9-year high. That contrast is the key insight. The dollar is not strong across the board, it is strong against currencies with cracking data. Sterling holds because British data has not cracked yet. So where does this go next? The near-term map is unusually clear. On the downside, the first level to watch is 1.3400, and below that the June floor at 1.3150 comes back into play. On the upside, a confirmed close above 1.3400 and then 1.3500 opens the road toward 1.3520. A one-week outlook published on the 29th of July penciled in a range of 1.3250 to 1.3450 with a central target near 1.3380, which tells you the market's own base case is drift rather than breakout. The trigger will be inflation. If UK price data runs hot enough to delay further Bank of England cuts, sterling gets its yield story back and 1.3500 becomes genuinely reachable. Here is the takeaway. Pound sterling to US dollar at 1.3450 is not a trend, it is a truce. The bulls keep the short-term advantage while price stays above that 100-hour average and the longer-term 100-day line, but the fuel that drove the climb from 1.3150 has largely burned off. Watch three numbers and ignore the noise. 1.3400 confirms the bears, 1.3500 confirms the bulls, and the 3.75% base rate decides which one gives way first. Until then, expect plenty of movement and very little real progress.